Good afternoon, this is Blake Young, and you're watching TheoTrade Nightly Video for December 29th, 2022. Today we're going to be talking about rising on retail traders. The reason why I want to talk about retail traders is because it appears that the institutional trader has gone. They've already gone for the year. They've already adjusted their positions, taken their tax loss harvesting, and stepped to the sidelines. And that is what we would come to expect in most years. In most years, the big institutions, they have so much they have to do that they're generally trying to be settled out, closed out, tax loss harvested so they can get settlement and reposition for the new year, whether that's cash or into new positions, by midweek in the final week of trading. And that's kind of what we've seen. If you look at the average volume over the last few months, our average volume has gone from 2 million contracts a day on the S&P futures down to an average of 1.6. So we're almost half the normal volume. In addition to that, our volume over the last 2 weeks has got lighter and lighter and lighter. In fact, today's volume, yesterday's volume, and the previous 4 days overall, we're seeing about 1 million traded contracts per day. Our average is 1.6. And again, we're well off the averages back here in October. October's average is 2.6, 2.8, 3 million shares during that time period, and here we are trading at a million. So the volumes are extremely light. That would seem to infer that this is not institutional trading. So when we saw the rally today, a couple of things we can also decipher from this. The rally occurred on lighter and lighter volume. In addition to that, that volume occurred, generally speaking, in the first hour of trading. In that first hour of trading, we saw all the money move into the market. Institutional traders probably weren't repositioning at that point. They were already done. All that volume occurred. What volume did occur, almost half of it happened in the first hour, and then the rest of the day was nothing. So only 500,000 trades for 6 hours. That's not a lot of volume. And we saw technology, communication, and consumer discretionary going higher and pulling the S&P up with it. But when we look at the defensive sectors like consumer staples and utilities, they were up a little bit, and this was happening while crude was down, copper was down, and even the US dollar was down. So there's definitely some repositioning going on. If we're to look at this from the intraday perspective, here's your intraday chart. You can see that we rounded up through here, and what selling did occur yesterday, we settled in down here about 3,800. By the time we opened, we are already pricing in a 38.35 move. This was chasing. The retail trader missed all of this action, and so on the open, they jumped. And we saw there's a volume spike there, and then from that moment on, within about an hour of trading, our volumes had dropped down to 38,000 contracts per 15 minutes. And then we saw a final spike right there into the close. But reality is all that action, all that motion, there was no volume behind it. We did trade above the overnight highs from Wednesday. We erased that selling, but we were clearly in consolidation still from the past week. If we go back 1 week, we can see the lower highs that are going on in the charts and the higher lows. The consolidation seems to be favoring it rolling over at resistance, which means that we might see a pullback tomorrow as low as maybe 38.20. It wouldn't surprise me to see it not even reach there, to just settle in about 38.40, and we can finish off the week flat. And the data would suggest we are. Now, unless we see another random rally in the morning, it does seem to suggest that we're going to probably fade back into this area and settle in the middle. If we do break higher, I'm not going to expect it to trade this price pattern higher. I'm not going to look for a 90 to 100 point move. I'm going to look for it to go maybe 20 points higher to retest these previous highs here at 39.20 or here at 3900. But again, it looks like we're going to fade back in here. And if the retail traders were the ones pushing this higher and then running out of steam and could not push it any higher all by themselves, it probably does mean that we're done. The momentum is gone, and our very light trading day, which is what I expect to happen tomorrow, we'll probably see a drift lower, maybe a drift higher, but I'm talking about 20 to 40 points in the entire range of the day. That's my expectation. And if we look at the week to week, going back here in 3-year weekly, you can see that last week we closed within 3 points of the previous week's close, and currently we are within 1 point at this moment of the previous week's close. Looking at your ranges, our range has gone down to 96 for the entire week. I would be surprised to see us trade in anything larger than half of that weekly range going into the last trading day of the year. So it doesn't look like there's a lot of institution. It looks like it's retail hopium driving the market. And if we were to look at the sectors that they're really pushing money into, it's still going to be into the hope type trades. Look at technology, look at consumer discretionary, looking at communications, and you can see that's your biggest gap up. You're chasing it, and you still didn't get average volume for the last 4 days. And our average volume, even on technology, you can see back there in October, average volume was about 9 million, and we're now seeing an average of 7 million, and today's entire trading day was about 5. So we're trading about 60% of the volume that we saw back in October. So if I'm looking for something, this is probably where I want to see it run out of steam and roll down. And we could do the same thing with technology or communications or consumer discretionary, and look to time maybe a rollover in lower highs, lower lows. You can see we created bearish divergences as we hit these highs and just stopped moving. Even our intraday volume, we could not get to average all day long. We had it bookended with 2 spikes, and that was it. As we look at technology, let's go over to XLC because that's in the same realm and some similar stocks. You can see this a little bit cleaner lower high. And again, no volume, or volumes are just drying up through here. And a lower close, if we close below this 47.90 or maybe 47.85, then I would expect us to fall back and probably find the middle of this range in the 47.40 area. Consumer discretionary, very flat at the previous resistance from Friday, at the previous resistance, and this reversal through here, and the resistance early on in the day. It looks like consumer discretionary hit its head pretty well at about 130, and I would be looking for it to fall back to about 128. Not a big move, not a lot to do, because it just appears that we're readjusting, repositioning. Now, predicting out to the next year, I do want to highlight something that we talked about at the close yesterday. And this is economic data. This is monetary policy. And you can go look at Fred, the Federal Reserve's website. You can go look at multiple economic websites. But you can also do it on the thinkorswim platform under the economic data. And so I actually pulled this up from CPI. But let's start with monetary policy first. Monetary data. So on the economics tab, clicking on monetary data, and you can look at the M2 and its components. M2 is released every month. M1, just to give you a really quick background, M1 is cash and cash deposits. That's pretty much it, cash and equivalents. M2 includes quickly convertible cash type assets like CDs. So you can convert CDs and other quickly converted into cash type of instruments. So M2 is a great measurement for what is the true monetary supply. M3 is a better indication of monetary supply, but it's only released once a quarter. And so M2 is more applicable, I guess is what you could say. It's more usable because we're getting the data every single month. Now, this is the M2 showing monetary supply, cash or cash equivalents, going from the 297 million to a equivalent of 21 billion in cash sitting around, or sorry, 21 trillion in cash. I got to put my comma there. So from 297 billion, to $21 trillion in monetary supply, money floating out in the market. Now, this little blip over at the top, it may not look that significant, but it is actually huge. We saw monetary supply peak out up here at 21.7 trillion. As we're sitting this month, we're at 21.3 trillion. That is a collapse of $400 billion. But even more so, take a look at this as percentages. Percentage change. This is the most significant change in monetary supply, going from an increasing monetary supply to a contracting or tightening monetary supply. We've never seen this ever in the history of the United States, at least as far back as we can go on this monetary supply chart, this M2 chart. We've never seen this type of reversal of monetary supply and economic tightening when it comes to monetary supply. If we're to zoom in on this, we did have the little spike here, and then we saw it drop. Now, notice that all these other times that we crossed below the zero, that oftentimes, shouldn't say every time, that we had a big outflow of capital and then a tightening, it was around a recession. So we had recession spending to try to get us out of the recession, and then it collapsed down as monetary policy was tightened post-recession, which, great. That's fine. That's maybe what we could expect. And that's what these gray areas are here. These lighter gray are recessions. But this is happening pre-recession. We're seeing monetary tightening pre-recession, at least according to the way we're reading this chart. And if I zoom in on here, you can see when this all occurred. This is that increase of spending, the monetary supply going out into the markets during the COVID lockdowns, during the exorbitant spending, trillions and trillions of dollars. We saw an increase of 6% increased monetary supply. So knowing that there's debt of $30 trillion, could we equate that to $1.8, $1.9 trillion of spending in a matter of a couple of months? Yeah, we can actually equate it to be a little bit more. But we then reverse that and try to take it out of the markets, and then we've continued to take it out of the markets, and we've raised rates. Now look at this year over year. If I go over to the year over year percentage change, this negative, as you're looking at, is matching the tightest monetary policy, not just the difference. Year over year, this is a massive amount, but this tightening policy, when we've gone from 26% down to 0 and going, trying to go negative from year to year, this is the lowest we've been. And so the tightest markets we're facing ahead of recession. And if this tightening of the market, and history tells us anything, that tightening of monetary supply will lead to, yes, fighting inflation. That's a good thing. But deflation likely as well. Now we go over here and say, well, what are we doing, or how are we doing with the inflation, consumer price index, CPI, and PCE? Now I prefer the PCE because I believe the Fed uses this one more. And so I want to look at what they're looking at. So we're going to look at personal consumption expenditure, ex food and energy. Now you can see the index has gone from way back here, and we're seeing the move higher, and we're looking at this index as increasing the value or the cost of this basket of goods, going from in the 20s all the way to 120. Now that seems huge, but when you're looking at inflation and the dollar's purchasing power, that makes a lot of sense. If we change this one to percentage, we're going to start with the percentage change here, and you can see there's that spike of inflation month over month. We're seeing it climb all the way to 0.6, and we can go back and match high inflation to this recession, not to this one, but yes, higher levels here, higher levels here, higher levels here in these recessionary time periods. But this still doesn't even tell us the whole story. This is just month over month changes. If we look at the year over year and say, look, they're doing good. Look how much they pulled it back from 0.6, 0.6, 0.6. This is just month to month. If we look at the year over year and we look at where we're at, yes, we've had some improvement as far as inflation goes with the rate hikes, but we've raised rate hikes almost 4%, and we've barely pulled it off of its high. This high level on inflation, if we look back, is the highest level outside of the massive amount of stagflation in the 1970s, well, from 1972 to 1982. This is the highest level of inflation that we've had. No other time other than this massive stagflation of the 70s have we had this high of inflation. And we're talking about the going back through the 80s, through the 90s, 2000s, and we're still, even with the pullback, we're still higher than inflation was in 87. This is a big deal. This also tells me that the Federal Reserve is likely going to continue to raise rates. If we continue to raise rates while we're already tightening the monetary policy, we will likely see disinflation or deflation. Going back into disinflation or deflation, generally speaking, the things that we will likely see is a weakening of consumer prices, but also the economy slowing down and seeing less spending. So we're going to watch for these bits of data going into the new year. We're going to watch for commodity prices to start rolling back down. We're going to watch for basic materials to struggle. And if we see all these things come together, then we can expect that disinflation is on its way, or deflation is on its way, and we will likely see a bigger slowdown in the economy. And then we'll try to pick the better defensive stocks like consumer staples, utilities, and healthcare, while we may fade technology and consumer discretionary. But we'll look at that in the new year. For now, just be aware, deflation and monetary tightening has reared its ugly head, and we will be watching that very, very carefully in the days and weeks to come. Thanks for watching, and we'll talk to you again next week.